In this video, we're going to talk about Vinco Ventures, trading under the ticker symbol BBIG. At the moment, there's a lot of volatilities coming out of the financial market, and we have to be careful about which stocks to buy, which stocks to sell. This video is going to cover the recent price action momentums and the technicals of the stock. Before the video begins, a quick heads up that my analysis is based on sessions already completed, and that it may not take into consideration the latest events. If that is the case, I will make follow-up videos to reflect them. With that being said, let's go on with today's topic. During the most recent trading session, the stock increased to around $2.80 before closing the trading day at around $2.64. We should pay attention at the $2.86 nearby because it was tested 2 times before, making it previously a significant support level. Nowadays, it is a potential resistance level in the short term to watch out for. Over the past 30 days, the trend of the stock has been bullish because it has been trending upward and most of its lows were higher than the previous one, except the last one, of course. From the perspective of a longer time frame, 6 months and above, the trend of the stock has been ranging between two ends that are actually far between each other, but generally speaking between $2 and $5, depending on which side is currently having the upper hand in the short squeeze. When we look at the price trend overall, it has been slowing on the bullish recovery, which was already fragile. Other than the short sellers, the stock is also under the influence of events occurring in the real world at the moment, making investors more reluctant at taking risks with more speculative assets. The trading volume of Vinco Ventures has recently been 26 million shares versus the average volume of 28 million shares. Over the previous 52-week period, its price fluctuated between $1.95 and $12.49. The market cap of Vinco Ventures is currently at $367 million versus the enterprise value of $362 million. The difference between the market cap and the enterprise value is the premium or discount financial market is willing to allocate to the company based on its current fundamentals, leverage, and asset composition. The enterprise value is the combined value of the company's assets minus the debts. If the company has a lot of debts or has a negative image, the assets may depreciate. With that being said, at the end of the day, it remains an estimation of how much the company is worth every time it publishes its financial statements. So it's less reactive than the market cap, but often more lenient for many startup companies. One key element to note regarding the enterprise value is that for many growth-type companies, one of the most significant assets they own is the goodwill. Goodwill is an expectation of the market that a company is able to generate more profit or to have more growth than other companies, partially because it may have a better management team, a stronger brand recognition, a bigger online following, and so on. It is what is unique about this company in particular compared to an alternative. In other words, it's not an actual asset to generate income, but it's often the reason why companies are perceived to be more bloated than they truly are, because the market cap may be lower than the enterprise value when it includes the goodwill. But if there is a liquidation, the goodwill will be completely gone before that, and we will be left with potentially less assets to distribute among shareholders and debt holders. When we compare the current price to its historical price fluctuations, the stock is 14% higher than the 1-month low, 18% higher than the 3-month low, and 30% higher than the 52-week low. On the options market, which often gives a hint on the market sentiment about where the stock price is likely going to go next, the implied volatility is 134% versus a historical volatility of 155%. The put-call volume ratio is currently at 0.18. It is normal for most stocks to also tend to have a higher put option volume than what they deserve, because many institutional investors hedge their long positions by buying put options. The most recent volume of options traded is 65,000 contracts a day versus the 30-day average of 118,000. For the most recent open interest, it has been 865,000 contracts versus the 30-day average of 875,000 contracts. In terms of shareholder structure, institutional shareholders own about 13% of its outstanding shares. The biggest shareholders include Nomura, Vanguard, and BlackRock. It is relevant to understand the shareholder composition of a company because it helps to determine if you should hold the stock long term or to view it as a trade opportunity. If the stock is mainly held by retail traders, then this can be a sign that the stock lacks the depth to justify long-term trust from shareholders. Typically, the consensus is that there should be at least 25 to 30% of institutional participation for the stock to be perceived as a sound investment and not just a short-term trade. This, of course, has a lot of exceptions because many great companies are also held by retail investors, but that so far is the exception and not the rule. Let's also take a look at the short interest present in the stock, which is the amount of positions aiming to profit if the share price goes lower. Sometimes when there are significant short interest in the total volume, this is a sign that there is an organized shorting operation going on, like what is going on with GameStop and AMC. The short interest is currently around 28% of the total float and 46% of the dark pool transactions. My opinion on Vinco Ventures overall is to buy a small position right now because the current trend is not broken yet and the stock is trading very close to a value region. If the price action during the upcoming week is favorable, we can potentially buy some more as well. The maximum exposure I would recommend is around 1 to 3% of your portfolio. For the immediate term, my recommendation is to buy the stock, considering the recent price actions and the promising price levels very close to where the stock is right now. I would recommend to separate your allocation in batches of around 20 to 30% at a time, so you can have enough room for later purchases. In this current market environment, I believe that we should be careful about taking positions and risk in the financial market in general, and in the equity market in particular. Because over the past decade or so, the financial market has been living with the help of newly created capital from QEs, resulting in a massive increase of asset prices and the corresponding decrease in their yields. And the low interest rate also contributed to reinforce this phenomenon because the financial sector would see its profit margins reduced and in turn keeps the returns of other sectors and employees low as well. At the same time, the market doesn't represent the real economy, and the real economy doesn't get reflected in the price of different securities. The market is a game of supply and demand, which will depend on a number of factors, not just the fundamentals. If the asset prices only depend on the fundamentals, then their performances in the Northern Hemisphere would have been more than mediocre, because things have been mostly stagnant over the years. A few things can explain why asset prices managed to remain high despite the stagnation of the underlying businesses. The first one is that over the years, there has been more money printed by different central banks to support their own economies. But because that money is distributed to banks and expected to loan to businesses to create more jobs, and that in fact there aren't that many opportunities out there, this money became capital that travels around the world and went into the huge financial melting pot. The QEs are now wrapping up in many countries, so I don't think that it'll remain as the main driving force over the next couple of years to keep the asset prices up. But it's compensated by the arrival of new capital from different regions to North America because it's perceived as a safe haven for investors. With the rising tensions around the world, this capital inflow will probably be sustained over the next couple of years, if not intensifying. The last phenomenon is the creation of artificial bubbles that are either supported by real market trends or completely fictional ones to allow market participants to play the game of hot potato and to either create profits or to safekeep their capital. The EV sector back in 2020 is an excellent example of this. But nevertheless, what it means for the market is that the degree of uncertainty is probably going to increase over the foreseeable future, as the expectation for a recession has been building up for more than a decade, and that the economic difficulties are accumulating around the world, especially from Asia. What this means for the market and for us is that the volatility is supposed to increase over time, which will provide opportunities to make a profit or to incur losses, depending on the timing and risk management. Another thing to note for this period of time is that we have to be very careful about having shorts. It's already riskier than having longs because the losses of shorts are not limited, right? Because there's no limit in terms of how far the stock can increase. But with the increased involvement of short sellers, I believe that the stocks being shorted will have an even higher probability of getting squeezed, which will result in potentially massive losses. So we're also observing more of an irrational behavior from market participants in the sense that very often people will choose to rush in a position not necessarily because the fundamentals are convincing, but because there's a buildup of demand in a specific stock and people will pile in to ride the gravy train with the rest of us. That kind of behavior is highly risky and may result in losses. It's worth pointing out that in 2020 and probably in 2021, the market has never presented that many opportunities, but it was also during that same period of time that many retail traders have incurred their biggest losses. A rule of thumb is that each position should be structured so that even if they don't succeed, they don't impact the portfolio stability. Positions should begin small so that there is an opportunity to average down later. And specifically for the growth stocks, I think that 5 to 10% overall should be a healthy weight for the portfolio. And each stock should represent about 1 to 3% of the positions. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.